So good morning, good afternoon, depending on where you are, and welcome to today's IAASB update, hosted by the CFRR, Center for Financial and Sustainability Reporting and Reform, from the World Bank, under our three flagship programs, Reparis for SMEs, eAssure, and Pulsar. Please note that this session is being recorded and there's simultaneous interpretation available in Albanian, Bosnian, Croatian, Serbian, and Russian. Please click the globe icon and select your language for the interpretation. To ask questions, we will kindly ask to use the questions and answers box. We'll address as many as possible live and in writing. We are here today with Adrian Fossard. He's our manager in the governance global practice, and he will deliver the opening remarks. Adrian, the floor is yours.
Okay, thank you. Good afternoon and welcome everyone. It's a pleasure to see such a large number of people joining for today's International Auditing and Assurance Standards Board update, hosted by the World Bank Center for Financial and Sustainability Reporting Reform in partnership with the International Federation of Accountants and the International Auditing and Assurance Standards Board. We're here to walk through important recent amendments and new standards that will help shape audit and assurance practice across the region, focusing on quality management, fraud, going concern, group audits, sustainability assurance, and audits of less complex entities. A warm welcome to colleagues from ministries of finance, public oversight bodies, professional accounting organizations, state-owned enterprises, academia, and the many other stakeholders across the ECHO region and beyond. We're grateful to our partners from the IAASB and IFAC and to our distinguished speakers for their contribution into organizing and conducting this event. This webinar is co-funded by our partners who make this regional knowledge sharing possible with support from the European Union, the Austrian Federal Ministry of Finance, the Swiss State Secretariat for Economic Affairs, and the Austrian Development Corporation. Why now and why does it matter? The IAASB's recent suite of standards and revisions is aimed at advancing audit quality, strengthening responsiveness to risk, and enhancing transparency, all of which is critical for investor confidence, financial stability, and public trust. We are navigating heightened expectations for governance and assurance, evolving fraud risks, and growing concern assessments. Increasingly complex group structures and the rapid emergence of sustainability reporting and assurance needs. Regulators, professional accountancy organizations, firms, universities in EU member states, accession and neighborhood countries, and other countries across the region are aligning frameworks, curricula, inspection approaches, and firm systems to these changes. Today's session helps explain the changes and turn policy and standards into practice. The update will cover, but is not limited to, the quality management standards, audits of less complex entities, and sustainability assurance, as well as strengthened fraud and going concern procedures, and clearer risk-focused guidance for all group audits, all aimed at delivering consistent, high-quality, and scalable assurance across engagements. Our objective is to clarify the substance of these changes and support your transition planning. Whether you are adjusting national regulations, revising professional accountancy organization syllabi and CPD, updating inspection methodologies, or transforming firm-level systems and methodologies. We have a very full agenda. Speakers will need to keep time so we can maximize discussion at the end of the question and answer at the end of the session. Wishing you an interesting event and a fruitful discussion. Thank you very much.
Thank you very much, Adrian. So now we're going to give the floor to our colleagues in IAASB. In the flow of the 90-minute presentation, we'll start with Willy Botta, who will give us the latest updates in quality management standards, ISQM 1 and 2, followed by Angelo Giardina, principal at IAASB, who will speak about fraud, ISA 240. Then followed by Kalina Shukarova, director also at the IAASB, who will speak about going concern, ISA 570. And then Jasper van der Hout, director at IAASB, will speak about group audits, ISA 600, followed by Claire Grayston, principal non-financial information and assurance, IAASB, who will discuss updates in sustainability assurance, ISSA 5000. And finally, we will have the audit of less complex entities also presented by Jasper van der Hout. That will be followed by a 20-minute session of questions and answers, and then the end of the webinar. So Willy Bota, please welcome, and the floor is yours.
Thank you, Jose. Thank you, Adrian. I assume that the participants can see the slides.
Yes, slides are in the screen, and they will be projected by Katia from Vienna.
Okay, thank you very much. And just again, want to say thank you very much for this opportunity. The IAASB team is really pleased to be with you here today to give you an update on some of our recent standards that we've released. And thank you for running through all the items. My colleagues and I, all from the IAASB team. Some of us are in New York. I'm talking to you from New York. We have Jasper, who is in the Netherlands, and we have Angelo, who is in Canada. But very happy to be here with you, and we will proceed through the various sections as you've indicated. So if we can go to the next slide, and maybe if we can go to the next slide, please. And I think we can skip that one because I think Jose has already indicated what the run of show is going to be. Right, so let's start with that one, quality management. So this is the topic on which I'm going to provide you with a little bit of information in terms of our series of quality management standards. Now, this package of standards was issued, this package of standards was finalized at the end of 2020, and it became effective as of December 2022. And what we generally refer to as our quality management standards comprise these three standards. So you first have ISQM 1 and ISQM 2, and those are the two standards that address quality management at a firm level. And then you have ISA 220 revised, which addresses quality management at the engagement level, and in particular, quality management in relation to audits of financial statements. With respect to other engagements, like, for example, sustainability assurance engagements or review engagements or other types of assurance engagements, the principles of ISA 220 are embedded in those separate standards. Now, with the issue of this package of standards, we really saw a significant shift in our focus on quality, and we were deliberately moving away from a compliance approach under our old quality control standard to a proactive quality management approach under the new quality management standards. So if we go to the next slide, if we start with ISQM 1, and I give you an overview a little bit of what this standard is about, is this standard has the requirements for a firm to establish and maintain a system of quality management. But very importantly, this is not just about having a system. It is very much focused on the actions and the behaviors that are driven by that system. And it emphasizes that the system of quality management is necessary to create an environment that enables and supports the consistent performance of quality engagements, and that provides a firm with reasonable assurance that the firm and its personnel fulfill their responsibilities under law, regulation, and professional standards, and that the engagement reports that are issued by the firm or on behalf of the firm are appropriate in the circumstances. And therefore, this standard establishes 8 components of a system of quality management and has requirements for how the firm sets up these 8 components of the system of quality management. At the center of the system is the governance and leadership of the firm. And then on the outside, around the other components of the system, including governance and leadership, are 2 key processes: the firm's risk assessment process and the firm's monitoring and remediation process, which I will talk about separately a little bit later. And then you have all the other components that are critical to proper quality management, and that is in terms of addressing your resources, your information and communication, client acceptance and continuance, relevant ethical requirements, and engagement performance. And in the end, what's very important is the last bullet point on that slide, is that this system is meant to be tailored to the circumstances of the firm. And I will talk a little bit about that as well. So on the next slide, I've indicated to you that governance and leadership is at the center of the system of quality management. All starts with leadership, and it is very much about setting the tone at the top. Now, in terms of leadership, the standard is prescriptive in terms of certain specified responsibilities that have to be assigned within the system of quality management. So this includes that the ultimate responsibility and accountability for the firm's system of quality management must be assigned to the CEO of the firm or the managing partner or a board, the managing board of partners. It depends a little bit on the structure of the firm. Also, the firm must assign specific operational responsibility for the system of quality management, as well as specifically operational responsibility for compliance with independence requirements and for the firm's system, for the monitoring and remediation system. Depending on the size of the firm, it could be the same person that is responsible for all those functions, or the bigger the firm is, those will probably be assigned to different people within the firm. But remember, the ultimate responsibility must be assigned to the CEO or managing board of partners or whatever the case may be. There's also a requirement that the system of quality management must be evaluated on an annual basis in terms of its effectiveness. And all these people that have responsibilities within the system, their performance must also be evaluated. Now, very important here is the second main bullet point on that slide, and that the system is very much focused on creating a culture, that demonstrates a commitment to quality. So part of the policies and procedures of a firm is the responsibility of all personnel for quality and their expected behaviors in that regard. And specifically, that leadership demonstrates a commitment to quality through their actions and behaviors. So if we can go to the next slide, I spoke about the two, or I mentioned the two systems, the two processes that are important to the quality management system. And the first of those is the firm's risk assessment process. And this really embeds a risk-based approach to quality management, and inherent in the risk assessment process is also the scalability and proportionality of the system. Because a quality management system for a large firm that performs audits of listed entities will look much different from a small firm that only performs compilation engagements. So this is where the scalability and proportionality comes in. So it sets out the framework for a firm to establish a risk-based approach by following the approach of establishing quality objectives, identifying and assessing the risks related to those objectives. So therefore standing back and say, so what can go wrong? What are the circumstances, conditions, events, or actions that can threaten the achievement of the quality objectives? Then implementing policies or procedures to address those risks. And obviously the firm needs information from inside the firm or information from outside the firm that helps them establish this process. Now, just briefly, in terms of each of those items, the standard, except for the two processes, the risk assessment process and the monitoring and remediation process, the standard prescribes what quality objectives a firm must establish, because that's the foundation, that's where it starts. So the standard says these are the things that need to be addressed. Obviously, the firm can also establish their own quality objectives, so they can add to those quality objectives, but they cannot remove a required quality objective. Based on the quality objectives, the firm assesses the risk. There's no prescription around that, although the standard does provide a framework for how the firm identifies and assesses its risks. And then also in terms of policies and procedures, that will be based on the firm's circumstances, very much driven by the types of engagements the firm performs, as well as the types of clients the firm have, different forms of entities operating in different industries. Those are the type of things that will primarily drive what these risks are and the policies or procedures to address those risks. There are guidance in the application material that will help firms to establish policies or procedures, but except for 6 specified responses in the standard, the responses must be developed by the firm in responding to the risks to the quality objectives. There are 6 specified responses that address things like, for example, annual independence declarations, that the firm must have policies and procedures to deal with complaints and allegations, and requirements around communication about the firm's system of quality management with those charged with governance of their clients, as well as external parties. If we turn the slide, the other process here is the monitoring and remediation process. And this is the process that really acknowledges that the firm's system of quality management is not static. So it builds in a feedback loop that ensures continuous improvement. Now, obviously, in an ideal world, you don't want deficiencies in your system, but equally, it is important that if there are deficiencies, that those deficiencies are identified so that you can address them. So we like to view it as a mindset that if there are deficiencies, a deficiency is an opportunity for improvement. Normally there's a very negative connotation to that, but really you should see it as an opportunity for improvement. Now, the monitoring and remediation process is characterized by this is the monitoring of the whole system, where the old ISQC1 standard focused specifically on, almost exclusively on engagement inspections. This is about monitoring the whole system through various monitoring activities that can be tailored to the firm's circumstances. Yes, there are still inspections that are required, inspections of completed engagements, but this is now very much driven by the risk profile of the firm and which engagements should be inspected after completion, with a requirement that for each engagement partner on a periodic basis, certain engagement files must be inspected. And then the second last bullet point there is very important, that it is also about remediating your deficiencies and ensuring that the remedial actions that have been implemented are indeed effective. And that's also where the annual evaluation of the system of quality management plays an important role. The next slide, regarding ISQC2, ISQC, no, that's not wrong. We don't have ISQC anymore. We have ISQM. So on the next slide, ISQM2 is the standard that deals with engagement quality reviews. Just going to wait for the slide to turn. There we go. So this standard deals specifically with engagement quality reviews. Now, engagement quality reviews is a firm level response to quality risks relating to engagement performance. So it is the firm saying, listen, we need to be very aware of how engagements within this firm is performed, and we want to implement this as a firm response to quality risks at the engagement level, but this review is carried out at the engagement level on individual engagements that are performed, to provide the firm with assurance that engagement teams fulfill their responsibilities in terms of law, under law, regulation, or professional standards, and that the engagement reports that are issued are appropriate in the circumstances. So within the system of quality management, one of the specified responses in ISQM1 is that the firm must have policies or procedures that determine which engagements will be subject to engagement quality reviews. And that must include audits of financial statements of listed entities, as well as any other engagements, not just audits or other engagements required to have engagement quality reviews in accordance with law or regulation, and then any other engagements that the firm determines should be subject to engagement quality reviews. And there in the application material, we provide some guidance in terms of how a firm may go about determining these other engagements. So the firm may look at things like, for example, when they have as clients entities that hold significant assets in a fiduciary capacity. So, for example, banks, insurance companies, pension funds, and also other factors like entities which may have a high public profile, or where the owners or those charged with governance of the entity has a high public profile. So only if an engagement quality review is required are you in ISQM 2. And when you're in ISQM 2, ISQM 2 provides requirements regarding the appointment and eligibility of the engagement quality reviewer, and then also requirements for the engagement quality reviewer in terms of performing the engagement quality review and documenting the engagement quality review. And then finally, on the last slide, I wanted to talk quickly a little bit about ISO 220 revised. And this is the standard that deals with quality management at the engagement level for audits of financial statements. So we just wanted to highlight a few of the key elements of quality management at the engagement level. Now, at the engagement level, this is all about the engagement partner, the responsibilities of the engagement partner. And obviously, the engagement partner can leverage the firm's system of quality management. And the standard is also clear that the engagement partner and other members of the engagement team can depend on the firm's policies and procedures within the system of quality management, unless in the particular circumstances of a particular engagement, it is clear that a certain policy may not be effective, or if the engagement team is aware of information communicated by the firm or by outside parties that certain policies or procedures may not be effective. Otherwise, they can rely on the policies and procedures of the firm. The engagement partner has overall responsibility for managing and achieving quality at the engagement level. And this is done by the engagement partner ensuring that they are sufficiently and appropriately involved throughout the audit engagement, and that they take responsibility for creating an environment that emphasizes the expected behavior of all engagement team members. Also critical to any engagement is the resources that are used on the engagement, and that's why the engagement partner has to take responsibility for determining the sufficiency and appropriateness of human, technological, and intellectual resources obtained or made available to the engagement team. An important part of what we changed when we developed this standard was also the definition of an engagement team, which is now very clear that the engagement team comprises the partners and staff of the firm, as well as any other individuals that perform procedures on the engagement. So that includes, for example, component auditors, any staff from a network firm or a firm that's not a network firm, or from a service provider. They are all part of the engagement team, and that means they are subject to direction, supervision, and review, which is then what the next bullet deals with: engagement performance. And this is very important, where the engagement partner takes responsibility for the nature, timing, extent of the direction and supervision of the engagement team, and the review of the work and the specific items that the engagement partner must review. Finally, the engagement partner at the end of the engagement has to do a stand back and say, but did I manage and achieve quality on this engagement, by determining whether they've been sufficiently and appropriately involved, such that they are able to determine that the significant judgments and conclusions reached on the engagement are appropriate, and that the firm's policies or procedures were taken into account in complying with this standard. So in terms of quality management, I'm going to leave it there. I think I am now going to turn over to Angelo to tell you a little bit about our fraud standard.
Thank you, Willie. Yes, we're gonna pass on to Angela to speak about the updates in the ISA 240. Presentation is already in the screen. Angelo, can you hear us?
I can. Can you hear me?
Perfect.
Yes? Okay. Okay, wonderful. Thank you so much, Jose. and a big hello to the audience. So I understand that I have 15 minutes for this presentation, which you'll appreciate isn't a lot of time, but I'm going to try my best to get through the key drivers of the project and then touch on some of the most significant changes in the standard. However, if you want to continue this conversation, please feel free to reach out to me, Jasper, or Willie, and we'll be happy to engage with you further on this. Okay, so we're on the right slide here. Let's stay here for a sec. So I'll start with why the IAASB launched this project way back in 2020, just to give us a little bit of context. Some of you may remember that the period between 2018 and 2020 had several high-profile corporate failures around the world, including two big UK-based companies, Carillion and Patisserie Valerie, and the German payment processor giant Wirecard, amongst others in the world. And these scandals were shining a brighter spotlight on the role of auditors, and particularly the role that auditors play at detecting fraud as part of their financial statement audits. So although it remains a very well-established principle that the primary responsibility for preventing and detecting fraud rests with management and those charged with governance, there was, in fact, a growing expectation by the public for auditors to do more to detect fraud during their audits. And this led the IAASB to launch a project. And this project was launched alongside the project to revise the going concern standard, which you're going to hear about fairly shortly by Kalina. And the project was intended to enhance, clarify, and strengthen the fraud auditing standard in several key areas. So let's go to the next slide, please. Okay, wonderful. Thank you. So this slide outlines the 4 key objectives of the project that were described in the project proposal that was approved by the board when the project was launched. So number 1, clarify the role and responsibilities of the auditor for fraud in an audit of financial statements. 2, promote consistent behaviors and facilitate effective responses to identified fraud risks. 3, reinforce the importance throughout the audit of the appropriate exercise of professional skepticism in fraud-related procedures. And 4, enhance transparency on fraud-related procedures, including strengthening communications with those charged with governance and the reporting requirements in the auditor's report. So those are a lot of objectives, a lot of key objectives, and that brings us to the next slide. And I'm going to tell you a little bit about this slide. And that's perfect. Thank you. So that the previous slide had a lot of key objectives, but what we heard from the consultative advisory group, in fact, which was a multi-stakeholder group that was advising the board during this project, they recommended that the board, in fact, consolidate some of those key objectives that I outlined in the previous slide to capture the essence of what the board was trying to achieve. And this, the board introspected and looked at the feedback that it had received and recognized that stakeholders were most interested really in 2 things. They wanted greater consistency in fraud-related procedures. And finally, they wanted the revisions to the standard to drive meaningful changes in auditor behavior. So auditor behavior, including while performing risk assessments and in responding to assessed risks. So with that in mind, the board coalesced around the key objective that you see on this slide, which is namely to promote consistent practice and change auditor behavior. And this slide that you see here became emblematic of the project and will be familiar to many of those in the audience that have been following this project closely. Now, to achieve this objective, the board focused on the 7 key areas on this slide. Top of the slide, we've got reinforcing the importance of professional skepticism throughout the audit. Of course, professional skepticism is a cornerstone of high-quality auditing. The board strengthened this area by doing 3 things. First, the board introduced a key concept in the standard that, in fact, professional skepticism is critical to supporting the quality of auditor judgments throughout the audit. Another, again, in the professional skepticism, the board added a new requirement that auditors need to remain alert throughout the audit for previously unidentified fraud risk factors to reduce the risk that fraud risk factors are overlooked by auditors. Because you'll note, fraud risk factors, research shows, often accompany fraud. And also, the board wanted auditors to remain alert to circumstances that may be indicative of fraud or suspected fraud. And then third, under professional skepticism, again, is removing references in the standard to past experience that the auditor may have with honesty and integrity of management and those charged with governance. The board thought that those references to past experience of honesty and integrity were in fact counterproductive, because the auditor should approach each audit with a fresh pair of eyes, free from biases and assumptions that could undermine the exercise of professional skepticism. And then moving to the bottom of the slide, we've got the all-important documentation requirements. These were enhanced, and it really required the auditor to tease out some of the judgments that the auditor makes throughout the audit. And that was another key area in this objective that the board coalesced around. Okay, in terms of the third area, which deals with clarifying and emphasizing the auditor's responsibilities, this is absolutely key. The board sought to refocus the revised standard on what the auditor can do, in response to concerns that the previous standard was placing too much emphasis on what the auditor cannot do. Now, this led to three big revisions in the standard. First, the description of the auditor's responsibilities was moved up in the standard to come before the descriptions of management's responsibilities and the responsibilities of those charged with governance. This change was meant to ensure that the role of the auditor in an auditing standard is not overshadowed by the roles of management and those charged with governance. Second, the board separated the description of the auditor's responsibilities from the description of inherent limitations in an audit. Now, in the extant standard, you'll remember that those concepts were described in the same paragraph, which the board understood was leading to confusion about what the auditor was actually responsible for. Of course, the board recognizes that the standard needs to continue to explain the inherent limitations of an audit. Those are critically important. Why? Because limitations are real and they're outside of the auditor's control, such as, for example, when management colludes to override controls and falsified records. But the board concluded that these limitations should be described separately from what the auditor is responsible for, and that was another big change. And finally, the board introduced a statement in the revised standard that inherent limitations, in fact, do not diminish the auditor's responsibilities relating to fraud, which you'll remember is to plan and perform an audit to obtain reasonable assurance that the financial statements as a whole are free of material misstatement due to fraud. Okay, let's move to the next area on this slide, which is actually, if we can go back to the previous slide. Thank you so much. And the one after this, the slide after this, please. One more. Perfect. Let's stay on this slide for a little bit more. Yeah, let's stay here. Thank you. So, enhancing ongoing communications between the auditor and management and those charged with governance was another key area. The board recognized that it needed to strengthen these requirements. In fact, to strengthen the reporting requirements between the auditor and management and those charged with governance about fraud-related matters, including during planning, but also at other stages in the audit. And this underscores the importance of two-way communication in fulfilling the auditor's responsibilities related to fraud in an audit. And then the fifth area on this slide has to do with risk assessment. So the revisions to the fraud risk requirements were actually strengthened by clarifying that the auditor is applying a fraud lens to the requirements in ISA 315, revised 2019, particularly around the understanding the auditor obtains of the entity's internal control system. So including the entity's culture and management's commitment to ethical values, also the entity's whistleblower program, which research shows plays a pivotal role in detecting fraud. That understanding of the whistleblower program includes an understanding of how the entity investigates and remediates allegations of fraud through the hotline, for example. And then also importantly, the auditor obtains an understanding of the entity's own fraud risk assessment, which is particularly important at informing the auditor's risk assessment. And then another key area here on the slide was to enhance the auditor's response when fraud or suspected fraud is identified, which is a critical moment in any audit, where the exercise of professional skepticism becomes very, very important. Now, I'll touch on two changes in the fraud or suspected fraud requirements. The first big one is that the board just aggregated all of the requirements all in one section. There were, as you'll appreciate, already requirements in the extant standard, but new requirements were also added to the fraud or suspected fraud requirements. And this aggregation is just meant to enhance the consistency in how auditors are handling such situations. And then the application material also clarifies that tips or complaints that come through the entity's whistleblower program, the hotline, may sometimes involve allegations of fraud, and those are captured under these new requirements. So the auditor needs to do something with these things. And then the revised standard also clarifies that for the fraud or suspected fraud area, that it is in fact the engagement partner, not the engagement team, who is responsible for determining the effect of the identified fraud or suspected fraud on the overall audit approach. And this shift ensured that there's greater accountability at the leadership level of the engagement. And then finally, on this slide, we've got the last area that's dealing with transparency. Now, stakeholders had consistently expressed the desire to the IAASB for more transparency in the auditor's report. Actually, in the previous, if we can go back to the previous slide, please. Yes, it's just this last area on transparency, and then we're done with this slide. So the board introduced requirements in the fraud standard, in the revised standard, which expands on the requirements in ISA 701, which deals with reporting of key audit matters. And these new requirements in the revised standard were meant to drive increased and enhanced reporting in the auditor's report about matters related to fraud that required significant auditor attention and that were matters of most significance in the audit. And those are, just to sum up the slide really quickly, these are the core pillars of the board's strategy in promoting consistent behavior and driving behavioral change. And if we could go to the last slide, please. Next slide, please. Thank you so much. Okay, this is the last slide. I've said a lot, and please do reach out to us if you want to drill down into any of these areas, and certainly we can pick up questions during the Q&A. Here's a slide that just tells us about next steps. So the IAASB published its final pronouncement in July of last year. The board also published at the same time a basis for conclusions, which is a really good source of information if you'd like to understand the reasoning behind the board's decisions and the revisions. It also published a fact sheet, which is a quick snapshot of the key drivers of the project and the key changes made. And we also published a 4-part video series where you'll see me, Jasper, Isabel, and the task force chair, Julie. And we dive into specific changes and drill down into specific changes in the standard. And finally, the standard, just to kind of cap it off here, it's effective for financial periods beginning on or after December 15th, 2026, which is coming up. And that aligns with the effective date of other new standards, that revised standards, including going concern, which we're going to talk about soon. And that concludes my prepared remarks, Jose.
Thank you very much, Angelo. So let's give the floor to Galina Shukarova to speak about going concern, ISA 570. Galina, your slides are on.
Thank you so much, Jose. Hello, everybody. It's a pleasure to be here today to talk to you about going concern, ISA 570 revised. If we can go to the next slide, please. So this slide captures the reasons and the rationale why this project was initiated. As Angelo was speaking before, fraud and going concern were public interest related issues with a pervasive nature for the audit. So the board initiated these projects in parallel. On going concern specifically, there were some events from the environment that were causing an increased focus on going concern and stakeholders' expectations about a more robust and enhanced standard, especially enhanced transparency. So we had corporate failures that were driving this initiative. This also coincided with following the pandemic, uncertainty in the economic environment, and other factors which were driving a need for the board to look at this topic again and to strengthen its going concern standard. In terms of the objectives, three objectives there that the board sought out to achieve. Very similar as the fraud standard, to promote consistent practice and behavior by auditors. And then to strengthen the auditor's evaluation of management assessment of going concern. And the last piece was to enhance the transparency related to going concern. And when I'll talk about transparency, there's many pieces there. Another public interest consideration, which is not on the slide, but was very much recognized through this project, was the need to coordinate closely with the International Accounting Standards Board, given that the topic of going concern is very much linked with the applicable financial reporting framework. So throughout the project, the duration of the whole project, there was active and ongoing coordination amongst the two boards. And when I'll speak separately about certain proposals, how that alignment was being considered throughout the project. If we go to the next slide, I will start talking about the key changes. So starting from terminology, the key concepts about what is a material uncertainty related to going concern. The extant standard does not define a material uncertainty. Neither does the applicable financial reporting framework, neither does the standards of the International Accounting Standard Setting Board. So this concept of a material uncertainty has a meaning both for the auditor and for the preparers in the appropriate context. So what the board did is clarified by defining what a material uncertainty related to going concern is. And in doing so, they also provided an explanation for that threshold, which is called may cast significant doubt. What does that mean? Now, that threshold about may cast significant doubt was clarified in terms of the magnitude of the potential impact and likelihood of occurrence of the identified events and conditions, unless management plan is for future actions is able to mitigate those events. So the definition is basically a net definition. It says that a material uncertainty related to going concern is the net impact after you've considered the magnitude and likelihood and management plan. And this is basically the unresolved events and conditions that individually may cast significant doubt. So when I say this gross and net, this is an important concept that the standard brought into this revision. So there are certain requirements that apply at the gross basis. And when I say at the gross basis, this is before consideration of management plan. And then there is certain requirements which are very much linked to the auditor's conclusion on a material uncertainty that apply on a net basis after that has been considered. So if we move to the next slide, So this slide basically explains in 4 pillars what are the key areas where the work effort for the auditor was strengthened. Now, a going concern 570 is one of the peculiar standards in our handbook. It is because it addresses a number of work effort requirements, but it also has its own reporting section. So usually the matters related to going concern are addressed in the standard rather than in the reporting standards of the 700 series. And I'll talk about that later. But the work effort, which is captured by the standard, is basically enhanced in the risk assessment. And how this is achieved is by, very similar to the fraud project, applying a going concern lens to what 315 already requires and providing specificity of what the auditor should obtain an understanding for during the risk assessment, which is specific to going concern matters. In addition, the standard clarifies now that while the auditor is doing that work is undertaken on a gross basis. So the auditor does not look at the plan at that.
Hi, colleagues. Apologies, we have an IT issue right now. Apparently, Kalina was disconnected. We're gonna get there soon. Solved. 1 second, please. Colleagues, in the interest of time, we're gonna move ahead with Jasper, and we will recontinue with Kalina as soon as she's back online. Thank you very much. Jasper, please, the floor is yours.
Thank you, Jose. So maybe we can go a few slides forward to the slide for group audits. Thank you. So today I'm going to tell you a little bit about our group audit standards. In the coming 15 minutes, I will highlight the objectives of this standard, what the key enhancements were that we've made, and also which implementation material is available. And then I hope that after this presentation, you have an idea what the key changes were and where you can find additional information. If we can go to the next slide, it shows the timeline of the IAASB. We started with this project. It was 11 years ago that we started with it. The reason why we started this project was partly because of inspection findings. They were reported by regulators and shared with us. Otherwise, we're also doing outreach. We did outreach, general outreach with our stakeholders. We're also working at the same time on our strategy and work plan. And we also had an ISA implementation monitoring project. And all of these things, they indicated that we needed to make changes to our standard on group audits. So if you look at the timeline and if you're following our projects, you might think, oh, that took a while between the project proposal and the exposure draft. But the reason for that was that the work on the standard was temporarily paused because it's relying on other standards that were currently also then at that time being revised. So the standard was approved in December 2021, and 24 months later, in December 15, 2023, it was effective. So this standard has now been effective for over 2 years. You can go to the next slide. I will share with you what our objectives were in revising our group audit standards. The first one was keeping our standards on group audits fit for purpose. As part of this, we wanted to clarify the scope of the standard, which was indicated that was not clear to everyone. We also wanted to enhance the linkages between our group audit standards and our other ISAs. So, like as with for the fraud standard and with our going concern standard, the ISA 600 builds on top of our other standards. So, for example, our risk assessment standard, ISA 315, our requirements in there for all entities. And then specifically for group audits, there are other requirements added to that. So it's Galina mentioned the going concern lens, Angelo the fraud lens, and this add a group audit lens to the requirements. Under this objectives was keeping the standard scalable. The second objective was encouraging proactive management of quality. As Willy just mentioned, we made revisions to our quality management at the engagement standard, which is ISA 220. In the group audit purpose, we want to enhance how this is being done in a group audit perspective. Then we also wanted to enhance how actually the planning and performing of a group audit. We heard a lot of comments on the way it was done under the revised standard. So, for example, on the criticism on identifying significant components and whether that's fully aligned with the risk-based approach that we were introduced in other standards. The third area here under this objective was about restrictions on access to people and information. So what do you do when there are restrictions to access people and information? How can you overcome them? And during the development of the standard, we were also we encountered a real life example of that with COVID. There were of course a lot of restrictions on traveling, and that fueled as well the concerns around this topic and things we wanted to enhance. Then the third objective is fostering an appropriately independent and challenging skeptical mindset of the auditor. So really on focusing on professional skepticism and professional judgment of the auditor and bringing that in the standard. And then the last one is reinforcing the need for robust communication and interactions during the audit. So these are the communications between the group engagement team and component auditors, but also between the group engagement team and management and those charged with governance. So if you can go to the next slide. So this next slide shows all the key enhancements of it, and again, these are the key enhancements. Many more were made, and I'll give you a short overview of them. I'll starting at the top right corner, and I will go clockwise through them. The first one is clarifying the scope of the standard. There were lots of questions. When would the standard apply? Would it apply, for example, to shared service centers? Does it apply to equity accounted investments? Does it apply to entities with branches? So we clarified the scope of the standard, and we also, in doing so, we also broadened it. You're already quite quickly in this standard. So, for example, a bank that has 3 branches and they are then consolidated, then you're already considered to be a group audit. We thought it was better to be safe than sorry, so with the scope of it, so at least you're better in it, and then make the standard really scalable, so it works for smaller groups as well, than that you're left out with some critical requirements. The key to this clarified scope of the standard is the definition of group financial statements. The second area that we changed, that we clarified and reinforced that all ISAs need to be applied in a group audit engagement to stronger linkages to the other ISAs. As I just mentioned, ISA 600 builds on top of all the other ISAs, and those are still need to be applied. It's not that if you mean that you're in a group audit that you can just focus on just have ISA 600. No, you have all the other ISAs plus ISA 600 that you need to comply with. We clarified the linkage by using in applying. So you will see a lot of reference in applying ISA 315 and then follows the group audit specific requirement. I think that was it's one of the first standards where we introduced it, and at least how we introduced it at this skill. Then the third one is we introduced principle-based approach that is adaptable to a wide variety of circumstances and which is scalable. So this is super important given the scope of the standard, given that we broadened the scope of the standard. So how did we make it scalable? First of all, we have separate sections on the use of component auditors. So if you're relatively a small group audit and you don't use component auditors, and by having all these requirements related to the use of component auditors in separate sections, you can easily skip over those. The other one is that there was the construct of the work effort. We really focused on risk instead of identifying significant components. That is how we made this scalable. Of course, we did other things as well. There's separate paragraphs in the application material on scalability, for example. Then we clarified how the requirements in ISO 220 revised apply to manage and achieving audit quality in a group audit. So this builds on top of the changes that really just explained. In a group audit, we thought it was important to emphasize the role of the group engagement partner. He is responsible for managing and achieving quality in a group audit. And he also is responsible for being able to be involved in the work of the component auditors, and that throughout the audit. And the group engagement partner, we also highlighted that he is responsible that there are sufficient resources, and that the resources have the right competence and capabilities. Also here we clarified how the engagement team definition, as really highlighted, would apply in the case of a group audit. So that we clarified as well that component auditors are part of the engagement team. So then we're going to the left-hand side, the bottom of there, and the left. Oh, we stay on the same slide, please. So can you go one slide back? Yes, and we go here. We clarified how to overcome restrictions to access to people and information and audit documentation. So ISA 600 differentiates between restrictions on access outside the control of group management and restrictions on access imposed by group management. And especially on the first one, we added application material to explain how the auditor can overcome such restrictions. So, for example, when law or regulation restricts sending relevant audit documentation across borders, we gave examples on how to overcome that. The same when the group has a non-controlling interest in an entity that is accounted for by the equity method. Then, lastly, we added as well application material on what to do when you have to deal with a war, civil unrest or outbreaks of diseases. So that the last one of diseases was, of course, fueled by the COVID pandemic. So moving along, then we get to the seventh one that established a framework for planning and performing a group audit engagement. Sorry, still on the same slide, you can go back one. So this is the risk-based approach. I will talk to that later. The eighth area is that we clarified how the concept of materiality and aggregation risk apply in a group audit. Here is no fundamental change, but we really clarified a few things. So, for example, we clarified how to calculate component materiality, given the questions around that. And we also added a new definition on aggregation risk. The ninth area is that we strengthened and clarified the communications and interactions. And as I noted, these are twofold. These are the interactions with component auditors and with those charged with governance and management. With respect to component auditors, we highlighted that they may be involved throughout the audit. And we actually think that it's often very important that component auditors are involved, especially working in different jurisdictions. They have knowledge of the local laws and regulation. They also have knowledge of the local jurisdiction. The local branch, for example, or the entity of the group. So we highlighted that, and they can be involved in all stages. So, for example, in the risk assessment, and also in identifying, assessing, and responding to risk of material misstatement. The other thing that we highlighted here is the importance of two-way communication, the communication, and also that the communication is timely. And so not waiting till the end of the audit for communicating, no, throughout the audit, and sharing information with each other. So less static than it used to be the interpretation could be under the old standard. The last one, we enhanced the documentation requirements based on all these changes we made. We made changes as well to the documentation requirements to reflect that. And now we can go to the next slide, where I will pick up a little bit on the risk-based approach, because if you would ask me what is the biggest change to our group audit standard, that is really that we introduced a risk-based approach. So maybe a little bit what we had before in our extant standard. There you were required to identify significant components, send instructions to those components, receive those back, and it was kind of more a static and less interactive approach. And so we thought about this, and we wanted to make this a greater alignment. So why did we introduce this approach? Is really about we want a greater alignment with the requirements in ISO 315 and ISO 330. So more risk focused on the risks instead of identifying significant components. Then we also want to have a greater focus on the group auditor's responsibility to identify and assess the risk of material misstatement and design and perform further audit procedures. Also, for this risk-based approach, if you want to apply it, you really have to think about what, how, when, whom, and where. So the first step is what. So you are identifying and assessing your risk of material misstatement. That is the first step that you're doing. Then, as the group auditor, you need to think about how and when. So you need to develop a strategy to respond to these assessed risks. And then you need to think about by whom and where. So where do you need to do the procedures, which parts of the group to obtain sufficient appropriate audit evidence on these assessed risks, and then do you need to involve component auditors and not? And also the risk-based approach highlights that component auditors can be and often are involved in all phases of the group audit. So we really in our exposure draft we got some comments that the role of component auditors was underplayed. So we changed that going into the final standard. So with going to the last slide, just showing here the implementation material available. Go one slide. So what is the implementation material that is available? We have a basis for conclusions and a fact sheet, that explains on a high level what the changes are. Also, if you're interested in any of the changes on a high level, you want to read through them again, I really encourage you to read through that fact sheet. It's easily accessible. You can find that on our website, and otherwise always feel free to reach out to me. Thank you for that, and say back to you.
Thank you very much, Jasper. We have Kalina again online, so we're gonna start again with the ongoing going concern. Kalina, the floor is yours.
Thank you so much, Jose, and apologies, internet was disruptive on my end. So if we can go back to the going concern slides, I'm not sure that should be previous to group audits. Yes. And yes, this is where we were. Thank you so much. So one slide ahead, please. The next slide. Okay, so I talked about the enhanced risk assessment. I think this is where I cut off. So the second pillar on the strengthened auditor's work effort is the required audit procedures to evaluate management assessment of going concern. And this is a big change because where the board landed is you always have to ask management to prepare an assessment, and the auditor always has to do work to evaluate management assessment of going concern, including the significant management judgment on which such assessment is based. Why the board thought that this is important is because in terms of concluding on whether there is no material uncertainty and making the other conclusions in the auditor's report, the auditor now has to do some work on understanding the significant judgment and the basis for those conclusions. The extant standard works on a different principle. You actually don't have to do work on the management assessment unless there are events and conditions. If there are events and conditions, you do it. Now, this requirement sits irrespectively of whether events and conditions are identified. So how does the auditor evaluate management assessment? The standard prescribes certain requirements which mirror something that sits in 540, our standard for audit for accounting estimates, with certain adaptations. So the auditor does procedures to assess the method, the significant assumptions, and data. And while going concern is a giant estimate, it still doesn't function always in the principles that 540 has. For example, a method, which is the approach that management has selected to assess going concern, may not be a mathematical calculation always in the context of 570. So it may be the method may be dependent on renewing borrowing facilities, getting financing, or making sure that covenants are not breached. So it does not only have a mathematical connotation in the context of 570, although those concepts are very much interlinked. So I see a lot of comments in the chat about scalability. And this is where we did spend a lot of time thinking about scalability, because going concern as a topic is equally important to entities of all sizes, small entities, complex entities, and so on. Because the driver behind going concern is not a size, it is whether there are events and conditions. And some events and conditions may have a huge impact on a small entity, while the same events and conditions may not have such a big impact on a larger entity because of its different resilience to these events and conditions. So because of that, we did spend a lot of time on this. There was a lot of concern from our small and medium-sized practitioners in terms of how do I assess an assessment if management has not prepared an assessment. So that condition in our standard is addressed by if management is not preparing an assessment, they are not complying with the requirements of the applicable financial reporting framework. However, the standard does recognize that not every assessment will be equally formal, will be equally the same. So, for example, management's analysis supporting the assessment in a smaller entity environment may be of different formality, different format, and that is recognized in the standard. But that is a different scenario than management not having an assessment. So those two things are differentiated, and rightfully so, because it is management's responsibility to have an assessment, not the auditor's responsibility to rectify the lack of an assessment. So that is on management assessment. A piece of that management assessment, and we've highlighted here on the slide separately, is the extended commencement date of the period of management assessment. A lot of complex words, but what it essentially means, the total timeline is still 12 months. That has not changed. The auditor is required to look at 12 months in the future. What has changed is when is the starting point of that future. So the extant standard links on the date of the financial statements, while what the revisions have done, they have extended that date to start from the date of approval of the financial statements. And why is that? It is because in some entities, it may happen that the auditor comes in quite late after the financial statement date. So, for example, let's say that the financial statement date is December and the auditor comes and does the work in September. That means they are essentially looking only at 3 months, remaining months to assess going concern and providing an opinion on that basis. Now, that doesn't give users very useful information because the period of reliance that basically they're getting through the auditor's opinion is just from September to December. So this change aims to kind of change that, and management is required to update their assessment to that date. Now, this topic was discussed a lot because of the linkages with the requirements in the international accounting standards. Now, we did coordinate with our colleagues on this topic a lot. Those standards do not prescribe a cap. They prescribe a minimal period for an assessment. And we have built into the standard certain flexibility for the auditor how they are considering this extended period. For example, one flexibility is you may have an entity that does not do periodical going concern assessments. In that case, this comes out of period for management. They have to do something in addition to give support to the auditor. So the formality of that assessment and the format of that extended assessment may not be the same. So this is what the standard recognizes. And also, that scalability piece is built into those requirements. There is also a requirement that asks you to have a discussion with management when they're unwilling to extend their assessment. And based on that discussion, the auditor may get support for management's basis of accounting. So on that basis, that forms part of the management assessment, and it was a big public interest issue. The last one, I won't speak too much because it's essentially clarifying what the standard already had, which is to obtain audit evidence about management plan for future actions. The requirements are enhanced, clarified, but essentially there is not a big change there. You still do this only when events and conditions are identified. So this is this requirement kicks in after the events and conditions. You would not have to do it in the situation where you do not have events and conditions and you're happy with management assessment. So if we move to the next slide, I'll spend some time talking about the transparency and the changes there. So the project did focus a lot about enhancing transparency for going concern. And this slide talks about the 3 pillars where that work, where the board undertook that work. So the first area is in terms of the auditor's report. And I will come back to this one because we have a separate slide. This is where the board spent a lot of time deliberating the auditor's report, taking into account the needs of users and different types of users and what they would expect to see in the auditor's report in relation to going concern. The second pillar there is strengthened and clarified requirements enhancing timely two-way communication with those charged with governance. So we looked at our requirements to communicate with those charged with governance. One of the public interest issues there was timely communication and then relevant communication. And then what if the assessment does not address the current environment? So all of those things were captured now into enhanced requirements to address those issues. And the last transparency bit there was very similar to fraud. There is a public expectations from auditors, and that is growing significantly about their public interest role in the ecosystem when there are problems about going concern, to report or to communicate to appropriate authorities when law, regulation, or relevant ethical requirements set out responsibilities for the auditor to do so. So that is a new requirement that's built in, and it is conditional on requirements in law, ethical requirements or regulation. And why it is conditional? Because you may have a jurisdiction, right? As a global standard setter, we cannot impose things that cannot apply globally. So if a jurisdiction does not have a protocol to report to these authorities, we would be putting auditors in a difficult condition to, for example, identify an authority, identify a process, and so on, how to report. So this is why this one sits there. If we move to the next slide, I'll talk a little bit about the auditor's report specifically. So what happened with the auditor's report is that the standard introduces an enhanced auditor reporting model for going concern. And how it does it is by including a new section in the auditor's report titled Going Concern section. And that section applies only when no material uncertainty exists. Now, there are two scenarios in that going concern section. One scenario, we call it the plain vanilla scenario. This is where no events and conditions were identified and no significant judgments were made by management. The second bucket in that going concern space is when there is a so-called close call. And a close call is a scenario where management made significant judgments to determine that there is no material uncertainty. And on top of that, the auditor concludes that there is no material uncertainty. So it's two conclusions, one based on a significant management judgment and the other one based on the auditor concluding that management appropriately concluded. But it is kind of the elevated risk area because significant judgment was involved, so it was not an easy conclusion. So that is on the slide, that green going concern section, which is the new piece. Now, while we were considering that enhanced reporting for going concern, we did consider the different information needs of users of financial statements. And where the board landed is not all users of all entities are the same. Some users, like those for listed entities, and by the way, that term listed entities going forward is going to be revised to publicly traded entities, which is a new term that will be used in our standards to have equivalence of a listed entity. So those users don't have access to the auditor, maybe for larger entities. There's a public, those are users who need more information about what the auditor did. For other entities, the users may have more contact with the auditor, with management, so they may have more insight. So we've kind of separated the reporting requirements, and we call this in our standards differential requirements when they only apply to a certain type of entity. So when the auditor reports in the going concern section for all entities, they're required to give two statements. The first statement is that they concluded that management use of going concern of basis of accounting is appropriate. And then the second conclusion is that a material uncertainty has not been identified. That is our plain vanilla. It comes in all circumstances. If you are auditing a listed entity, additional responsibilities kick in only when significant judgments are made by management that no material uncertainty exists. And in that case, the auditor provides a description of how the auditor evaluated management assessment. So that comes in only in the close call scenario. Now, all of the statements in the auditor's report do come with additional context. So the explicit statements were seen as a big change, and rightfully so. Although the responsibilities of the auditors already highlight these, they sit in a section with all the other responsibilities that the auditor has. Taking these responsibilities and explicitly putting them in the going concern section did create the board to think about how users will react to this new section. So there is additional context to those statements. For example, that they're not an opinion on a discrete matter or a guarantee as to the entity's ability to continue as a going concern. And we do have proposed additional subheadings to make that clear in the auditor's report. So I'm just briefly going to touch that the material uncertainty related to going concern section mirrors basically the differential approach. There are requirements for all entities, and there is additional requirements for listed entities that require a description how the auditor evaluated management assessment. That was proposed in relation to comments that were a material uncertainty is a serious event, and users should understand more what the auditor did to conclude on how they arrived where they arrived. So going to the next slide, I think this is the last slide, and I'm not going to spend a lot of time on that one, just to highlight that as for other projects, there is a basis for conclusion, final pronouncement, fact sheet, and we do have a frequently asked questions publication, which is a short publications and explains all the implications to the auditor's report as of the result of the enhanced auditor reporting model. So, Jose, with that, thank you. Apologies again for the interruption, and I hand over to you.
Thank you very much, Kalina. So we're gonna go over to Claire Grayston to speak about the Sustainability Assurance ISSA 5000. Claire, the floor is yours.
Thank you so much, Jose, and it's a pleasure to join this webinar today. So I want to share with you why ISSA 5000 was developed for sustainability assurance engagements, what it can provide, and why jurisdictions are adopting the standard, as well as some of the implementation resources that we have available to support implementation. Next slide, please. So first of all, the purpose of this project to develop this first international standard on sustainability assurance, ISSA 5000, was to provide a global baseline for sustainability assurance in order to reduce or avoid fragmentation in standards, so that the assurance reports could be interoperable, so they could be used across jurisdictions to meet different user needs or regulatory requirements. The International Organization of Securities Commissions, IOSCO, the Financial Stability Board, and other key stakeholders were calling on the IAASB to urgently develop a sustainability assurance standard prior to us commencing this project, in order to address the public interest need for consistent and reliable sustainability assurance. Although we did have in place and do still have in place ISA 3000, and we had in place ISA 3410, and they were being used for sustainability assurance engagements, they lacked the specificity that the market considered was needed for sustainability. So in order to provide that global baseline that's interoperable and can be applied across jurisdictions, as I mentioned, as well as across different practitioners and firms and different regulatory requirements, ISSA 5000 was written to apply globally to sustainability information prepared under any suitable reporting framework. So that could be, for example, the IFRS sustainability standards, S1 and S2, GRI standards, or the EU's ESRS standards. It covers both limited and reasonable assurance engagements, and those are clearly distinguished to allow, particularly for that transition from limited assurance, which is often being introduced initially, to reasonable assurance over time, and also to allow for combined assurance when limited assurance might be required on one aspect and reasonable assurance on another aspect of sustainability. It is a standard that's profession agnostic, so that means it's available to all assurance practitioners that apply the relevant ethical requirements and have in their firm a system of quality management in place. So it's also scalable, and that's important because it can be applied to specific sustainability information, so narrow scope type of engagements, or to the assurance on a complete sustainability report. So it doesn't need to be restricted in any way. It's very flexible in its application. So I note that 5000 is effective for periods commencing on or after December 15th this year, so 2026, and is available for early adoption. Next slide, please. So a trustworthy sustainability reporting ecosystem isn't just achieved by sustainability assurance alone. Key components of reliable, credible, comparable and trustworthy sustainability information are a suitable sustainability reporting framework, one developed under a transparent due process to meet the needs of intended users in the public interest. That combined with assurance under ISSA 5000 on information prepared under that framework, and a standard like 5000 that applies clear principle-based requirements for consistent performance of the quality, limited or reasonable assurance engagements, underpinned by the system of quality management that I mentioned, both at the firm level and applied at the engagement level. The third element is ethics and independence under the IAASB code, or requirements at least as demanding. And these provide, the code provides those robust ethical and independence requirements that need to be applied by the practitioner in doing these engagements. And finally, the ecosystem benefits from where there's an oversight and enforcement, whether that's by those charged with governance themselves, the professional bodies in the jurisdiction, or regulators. Next slide, please. So ISSA 5000 provides for, as I've mentioned a couple of times, both reasonable and limited assurance engagements, and that's with the intention of being equivalent to audits or reviews of financial information that we provide for under our international standards on auditing and review engagement standards. So ISSA 5000 is built on the basis of the tried and tested assurance principles and concepts in IAASB's existing standards, including ISA 3000, and drawing on key concepts where needed from our other standards. 5000 is comprehensive. By that I mean it covers the entire engagement. So it's right through, as I'll show on this slide, from acceptance and continuance of the engagement through each stage of the engagement, right through to reporting. Next slide, please. So why adopt 5000? ISSA 5000 is suitable for adoption for both mandatory and voluntary assurance engagements, obviously on sustainability information reported. And the reason for that is that it's provides the basis for that high quality assurance. It enhances the trust and confidence in the sustainability information reported. It establishes requirements for robust and reliable sustainability assurance engagements to promote that consistency and ensure a level playing field. And that's really, really important, where we're looking at a variety of different practitioners with different backgrounds. It provides that level playing field that they are all working towards the same standard of quality in these engagements. It addresses the approach to challenging areas. Now, as I said in the previous slide, it is comprehensive. It covers the entire engagement, but we did take care to spend time focusing in the standard on tricky areas such as narrative or qualitative information, estimates, forward-looking information, and value chain information that present particular challenges for sustainability assurance engagements. As a globally accepted sustainability assurance standard, ISSA 5000 does help to prevent that regulatory fragmentation that we aim to achieve by issuing the standard very promptly after those calls for us to do so were made by the community, international or stakeholder community, if you will. And it also promotes that interoperability and comparability. It is designed to work in tandem with the IAASB Code of Ethics, particularly the new Part 5, the IESA, IESSA, within the Code of Ethics, and they do complement one another. So we certainly recommend 5000 and the IAASB Code Part 5 are adopted together where possible. We have been working closely with IOSCO, IFIA, and jurisdictional policymakers, regulators, and standard setters to support their considerations in adopting ISSA 5000. So what does that look like? Next slide, please. You can see from this map that global adoption is rapidly gaining momentum, and that's been achieved already over the past year since the standard was released. All regions across the globe are making rapid progress. We're seeing moves towards adoption that's often coupled with decisions for mandatory assurance reporting, particularly the adoption of the IFRS Sustainability Reporting Standards, S1 and S2 in jurisdictions, but also jurisdictional standards for mandatory reporting, such as in the EU. And now that in the EU in particular, now that we're seeing the changes to the CSRD have been finalised, that limited assurance requirements will be based on ISO 5000, with carve-outs to focus on limited assurance and add-ons to meet the EU requirements. So, you know, that is a great step forward. And Australia is an example of an early adopter. They are the earliest adopter of ISO 5000, with mandatory requirements already in place under our standard. So we're continuing to monitor adoption and sharing the status on our website every quarter. So if you're wanting to see which jurisdictions in particular have adopted or are in the process of adopting, then please do refer to our Sustainability Assurance webpage. Next slide, please. The IAASB is providing clarity to address matters raised by stakeholders to support consistent implementation of ISO 5000 across practitioners, firms and regions, to ensure that those reports are comparable and easily understood. So we want to avoid different interpretations of the requirements by different jurisdictions. So how we're trying to achieve this is by early identification and prompt resolution of implementation issues of global relevance in order to drive that common approach globally. We're developing resources and encouraging stakeholders to leverage those resources for stakeholder engagement, capacity building and education at the jurisdictional level. So these matters are being identified by us through several monitoring mechanisms. Firstly, we have an ISO 5000 technical implementation contact group, and that comprises practitioners, both accountants and non-accountants from across the world, who are telling us about the issues that they are seeing as they develop their methodologies, as they apply 5000, so that we can address those in materials. We also have an online submission form where we're receiving implementation issues from any stakeholder that wishes to submit them. We're doing outreach such as this webinar today with stakeholders and to understand the issues that they are facing, as well as those that are adopting the standard. So the practitioners and firms and professional bodies who are working towards implementation, but also the standard setters, oversight bodies and regulators that are preparing for adoption. We're supported by a group of our board, the Sustainability Assurance Implementation Working Group, in working through how to address those matters. And we'll continue to issue implementation materials to be responsive to the needs of the market. Next slide, please. So we have available an extensive package of implementation materials that you'll find on our website, and I won't go through all of these. They're listed on this slide, and I just will note that we have some high-level resources, as I've marked there, which really provide just an overview of 5000 and related ethics, and in fact sheets and FAQs. But what I did want to highlight is we have some really key important resources that address a lot of the questions that come up from our stakeholders. Firstly, I'd highlight the ISO 5000 Implementation Guide. It is a comprehensive guide across the entire engagement. It provides examples and diagrams and is a really useful resource. I'd also highlight the Sustainability Assurance illustrative reports that we've recently issued, as well as the technical webinars, and those were presented last October, but they remain available to be accessed on demand, as well as the slides being available. So I'd commend you to those when looking at implementation. Next slide, please. So through our continuing outreach with stakeholders, we are hearing strong support for 5,000, and I think that's already reflected in the level of adoption so far in this short period of time. We are also, because of our commitment to supporting the consistent implementation that I mentioned, and through our monitoring mechanisms, we're also keeping track of areas that stakeholders consider need or would benefit from greater clarification. So I've listed those on the slide. I won't go through in too much detail because I think we need to move on to the next topic. But suffice to say, we're addressing these, and some of these we've already addressed directly in some of the materials that you'll find on our website. So I'll leave it there and I'll hand over to Jasper for the next segment. Thank you.
Thank you very much, Claire. Before going to Jasper, just a call to the audience to post any additional Q&As. I've seen that the audience was very active, and all our panelists have been posting the answers. So I welcome you to go through the Q&A and check if there are additional questions. We have still a few general questions that we will post at the end. So now I'm going to go back to the agenda. Jasper, please, the floor is yours.
Thank you very much. This is the last topic for today, is the ISA for less complex entities. I will tell you a little bit more why we developed this standard, what the standard tries to achieve, and I'll give you a quick overview of what's in the standard and its design principles. So if you can go to the next slide, I will explain why we developed the ISA for LCD. So as you heard today, but also before that, like, we revised a lot of our key standards over the last decade or so. In addition to the topics we discussed today, you can also think about our auditor reporting project, our project on auditing accounting estimates, ISA 540, and our risk assessment standard, so that is ISA 315. And in revising all of these standards, for every revision, you see that the length of the standard increases. There's some good reasons for that. Like, the world we're living in is more complex than it was, like, let's say 20 years ago. Also, we got questions from regulators to add further requirements and guidance for auditors. So as we continue to revising all of these ISAs, the calls for a separate standard increased. And this was even though that we always consider scalability, as was highlighted throughout the different presentations. And also because of the ISAs, they are designed for all sizes of entities. So the ISAs should be able to be applied from the local bakery around the corner up to a large multinational. However, in practice, practitioners, they struggle to make the ISA scalable. Then on the other hand, we have the SME environment. So SMEs, so small and medium-sized entities, they represent about 90% of entities worldwide, and they make a critical contribution to the world economy. And many jurisdictions have relatively low auditing thresholds. So what happened is that some jurisdictions started to develop their own standards. For example, in the Nordic regions, so Norway, Sweden, also Belgium, France, Germany. So there was a risk of fragmentation in the global audit market, and that is a reason why we started this project. If you go to the next slide, is what we were trying to achieve with the standard. The ISA for LCE is a standalone standard. There are no links to the ISAs from the ISA for LCE and the other way around. Also, the ISAs cannot be used to top up the ISA for LCE. And what I mean with that, if you miss a certain topic in the ISA for LCE, you cannot go back to the ISA and say, like, oh, let's see what's in here and now I'm compliant with it. No, it's really a separate, standalone standard. It is also proportionate and tailored to the needs of a less complex entity. And I think this is one of the main selling points of the standard. This standard is not lesser than the ISAs, it's just different, and it has a simpler structure. And here maybe I'll give an example that maybe hopefully resonates with you. I often use the analogy with the maintenance manual of a plane. If you have a small Cessna plane, your maintenance manual will be shorter because it's just simpler in how it's constructed. If you compare that to a commercial airplane, sorry, I mean. So that for a commercial airplane, you'll have a way larger manual because it is complex. And it's similar to auditing a less complex entity. You don't need as much guidance and not all the requirements either. That's a little bit of the analogy that I've been using. So the main advantage of this standard is what we hear from practitioners. You know, or you have complied with all the requirements that are in there. It's not necessarily less work, because a question we often get is it's less work, and not necessarily. But you do need to document why you have not complied with something, because the standard is already made for the type of entity you're auditing. It's also easier to use and navigate, has a bit of a more intuitive structure to it as well. We'll get to that later. The standard does provide reasonable assurance. So we're not creating a two-tier audit. It's sometimes what I hear, like it's a lesser standard, lesser audit. The IAASB is of the view that if it's applied to the right type and size of entity, it will provide you with reasonable assurance. The last thing what I'd like to highlight is that it's a consistent application. This standard is promoting consistent application. It's easier to apply, and therefore there will be more consistency we expect, and this will increase confidence from users of these financial statements. I also want to highlight that this standard was never meant to be adopted in all jurisdictions. This standard is particularly meant for jurisdictions that have relatively low auditing thresholds, and these auditing threshold, and also don't have their own standard. So if you don't have your own standard and you have relatively low auditing threshold, this standard might be very interesting for you. If you go to the next slide, give you a little bit of an overview, because I highlighted that this standard is specifically tailored for less complex entities. So therefore, it's important that it's being used for the right type of companies. That you're not using a standard on an entity that is not less complex. And the reason why we also to maybe elaborate why we use less complex instead of not smaller and medium-sized standards or something like that, is that we think the importance is the complexity of the entity and not the size. You can have a very small entity that is super complex, and that's why we are focusing on the complexity. So before you can use the standard, there's 3 hoops you need to get through. There's specific prohibitions. So we decided that the standard cannot be applied for certain types of entities. For example, not for listed entities, also not for banks and insurance companies. Jurisdictions can add additional types of groups for these specific prohibitions. Then we have qualitative characteristics of an LCE. If your entity is criteria to see whether your entity that you're auditing meets those, you can use it. So, for example, the things to think about is the organizational structure, the ownership, and the nature of the finance function. And the standard gives then examples of what we are seeing as a less complex entity. A few things to highlight here. This list of qualitative characteristics is not exhaustive, so you can consider other matters as well. It's also not intended to be absolute. If you don't meet one of the criteria, it doesn't mean you're directly out. Just looking at it more holistically. There are also for numerical indicators in the standard. Those are more indication, and you need to look at all the characteristics combined to really get to the conclusion. Having said that, if you have any uncertainty whether you can use the standard also makes it clear you're probably not the right entity and should probably use another standard. Then lastly, actually, there are two more points. First, the third point is the quantitative thresholds. The quantitative thresholds have to be set by jurisdictions, as it's hard to do on a global basis. It's kind of a safety net that is really the standard is used for the right type of entities. The last thing I want to highlight on this slide is are the group audit considerations. You can use the standard when you are a group audit, especially given the changes in the scope of our group audit standards, because we use the same definitions in the IFAC as in the ISAS. We think that even a less complex entity can be a group audit. However, the use of component auditors is restricted. It's only allowed in the limited circumstances, and that's only when there is physical presence is needed. So, for example, for an inventory count, so then you can use another auditor. If you go to the next slide, give you a little bit of an overview of the design principles of the standard. We started from scratch, so that has some advantages. We agreed first on certain key principles, which are the same as in under the ISAS, that is on the risk-based approach, and it's principles-based. Then, given that we started from scratch, we could enhance what is in the ISAS and also tailor it for an audit of a less complex entity. So, for example, how it's written, really focused on the expected output, and we try to make the requirements and guidance as clear and understandable and concise as possible. Also, the structure is a bit more intuitive, but I will get back to that. On the process, to give you a little bit of an insight for how we got to the standards and the requirements. So we picked up the ISAS and we in first instance only focused on the requirements. So we took out the introduction that is often in the standards. Then we assessed for each requirement whether or not to include it in the IFAC. If for example, the requirements related to specific prohibition, like a listed entity, there are several requirements in the ISAS that are just for listed entities. We did not include them in the standard because they're not applicable. Also, we did not include requirements that we thought relate to more complex matters and that you then would not apply to an audit of a less complex entity. So, for example, the use of internal audits, we would not expect that a less complex entity uses internal audits. Then for the requirements that were left over, we then looked at them, how they could be enhanced, how they could be simplified. We combined some, we merged some. So that's a process to make the standard more understandable. If we go to the next slide, you'll see an overview of the flow of the standard. Go to the next slide, please. So if you see the flow of the standard, so it starts with broad concepts and overarching matters in part 1 to 3, then you go to more procedural requirements of an audit, and you end up reporting. So it really follows the natural flow of an audit. It has in total 10 parts, so the 9 that apply to everyone, and then you have part 10 that just applies to group audits. In addition to these 10 parts, there's a preface and also the authority that I explained earlier. Maybe one thing here on the guidance as well, like the standard includes less guidance than the ISAS, only when it was deemed essential for the application of a requirement, then we added guidance. So that's maybe another important thing to note, and that is why one of the main reasons why the standard is so much shorter than the ISAS. If we go to the last slide, is the adoption and implementation material. We did a lot on the adoption and implementation of the standard. We thought it's important, given that it is a new and standalone standard. It's from that perspective unique. And also, it's given that it's a standalone standard, it needs to be adopted in every jurisdiction and doesn't go automatically, like with many of the ISAs in many jurisdictions. The ISAs are indirectly adopted in a jurisdiction, but for this one not, it needs to go through a separate, in a lot of jurisdictions, through a separate process. I won't go through all of them. You can all find these on our website. on the landing page, there's a link to the ISFLSE, the page where you can find all of them. There's a wealth of information here, and if you think the standard might be interesting for your jurisdiction, I really encourage you to look, for example, at the webinar and the 3-part video series in which we dive a bit deeper into this standard and what the advantages are for them. And of course, if you have any questions, you're always welcome to reach out to me or any of my colleagues. So maybe Jose, with that, I'll close it off. And I hope you thought this interesting presentation from all of us.
Thank you very much, Jasper, and thanks all of the speakers for keeping the timing tight. We have 10 minutes for additional questions and answers. There has been 14 questions. 12 of them were already answered. So I will start with 2 questions that were already answered partially, but I want to give the floor to the 5 speakers in case there's any additional message that they want to strengthen in this aspect, because I think that they are important. So the first one is which is the main challenge that you see for practitioners to implement these changes in each of your areas? And the second is how would you see these challenges affecting on one side a large international network, and in vis-a-vis a smaller audit firm? So if you can take 1 to 2 minutes max to get your view on that, and then we're gonna go, if we have time, to additional questions that are specific. Thank you very much. Do we want to start in reverse order? No, maybe by Willy. The same order that we followed.
Yeah, thank you, Jose. So I think, when it comes to the quality management standards, I actually think, it's not really a challenge. It's a different way of thinking about quality management. And if you adopt the quality management mindset that is intended in the standards, you will find that you can adapt your quality management system very much to match the circumstances of your firm. And therefore, one would expect that a large, complex firm will have a very intensive, a very intense, detailed system of quality management, where a smaller firm that maybe doesn't even perform audits and only performs certain reviews and maybe related services engagements will not need a very formal, complex system of quality management. And many of the quality objectives could be met very easily. And also in the standard itself, we were very conscious about building in scalability and proportionality. So in the application material, throughout the standard, in terms of the different components of quality management, we've included what we refer to as contrasting examples to say a larger firm will have this and this and this, whereas a smaller firm may only need X, Y, and Z. And therefore, I think, take the time that is needed to really familiarize yourself with the standard, look at those examples, those contrasting examples. We're also aware that many professional accountancy organizations within different jurisdictions have issued additional guidance regarding to quality management. There's also available on the IFAC website. And I think you will find, if you truly embrace that principle of adapting it to the nature and circumstances of the firm, you will actually find that this collection of standards is easier to implement than the previous quality control standard. I'll leave it there, Jose. Thank you.
Thank you very much, Willy. Angelo.
Yeah, thank you, Jose. I answered this in the chat a little bit. It's a little challenging. I mean, the word challenging and what is challenging is always going to be in the eye of the beholder, right? The standard certainly was created with the revisions to it were always intended to be practicable and implementable. And there was a lot of discussion at the board table around these new requirements. Are they practicable? Are they implementable? However, certainly, I do want to address the question. There are requirements in here that are there's more clarity in the standard around fraud or suspected fraud, for example. And when you've got a large multinational company that gets allegations of fraud in its various hotlines, that's certainly going to, it's clearer that the auditor has a responsibility to get an understanding of the nature of these allegations. But I would say I think it's overall, I think the standard is although again, challenging depends, but it is practical and implementable. Thank you.
Thank you, Angelo. Back to Galina.
So what changes are most challenging? I would say the work effort changes would be most challenging for larger and smaller firms. It is because they are big changes compared to extent. I spoke about assessing management assessment. Particularly for smaller entities, it would be also challenging in terms of formality of management assessment. So this will probably be a situation where auditors would refer to some of that guidance, which talks about what is the difference between not having an assessment and lack of formality in the supporting analysis. So those things would stand out. Obviously, when you come to larger entities, there are additional reporting requirements. So I would say auditors of larger entities would have an additional implication in terms of preparing that description, how the auditor address management assessment of going concern in the auditor's report when there is a close call situation. And in terms of the standard basically imposing reporting requirements in all circumstances, there would be, I would expect, enhanced documentation required by firms in terms of supporting those conclusions. And that is actually one of the things that many firms are doing even today. But that additional reporting in the auditor's report and supporting the conclusion, because already the auditor is required to conclude, is probably going to enhance practice and quality amongst all firms, regardless of size and regardless of geography where they operate. Thank you so much.
Thank you, Galina. Claire.
Oh, apologies, took me a moment to unmute. Yeah, thank you, Jose. So when we talk about changes, of course, with ISO 5000, it is a new standard. However, it did draw on 3000, and that the challenges really relate. In some ways, that the changes that we made from 3000 into 5000. Make the process more straightforward in some regards, because, for example, we introduced risk assessment for limited assurance engagements to make it more clear what needed to be done. So a lot of the material in 5000 really helps the practitioner understand better what needs to be done in order to meet the requirements. So, however, there are many challenges in conducting sustainability assurance engagements. And that one of the questions that came through that highlighted that was because a lot of the disclosures may relate to narrative or qualitative information, that can be quite different for auditors who are more familiar with dealing with financial information that's sent primarily, not totally, but primarily quantitative. So that gathering of evidence, the considering of materiality, accumulating misstatements, and so forth becomes challenging, but is definitely doable. And that's what we work through in the standard, is helping the practitioner know how to deal with that. And I would also mention one of the other challenges that certainly practitioners have been grappling with is that sustainability information reported often encapsulates value chain information that's outside of the operational control of the entity, and that does make it more difficult for the practitioner to access evidence relating to value chain information. But again, we provide guidance and requirements in that regard that should help practitioners work through that. So finally, I just go to network versus smaller firms. So network firms, the larger firms are certainly already well advanced with their methodologies under ISSA 5000. So I do recognise that the smaller the firm, the more challenging it is to have the capacity to develop those methodologies. However, the standard itself is absolutely scalable, and the requirements are scalable for small practices, but also less complex engagements. So that has been definitely factored in as we developed the standard. Thanks.
Thank you very much, Claire. Jasper, one final minute and we close.
Okay, I'll wrap it up. So on ISO 600, I think the most challenging piece is the risk-based approach. It's a different way of thinking about this. Instead of looking at just selecting identifying significant components and then doing a review or an audit on those components, you now have to go line by line and see, okay, where in inventory, for example, are my risk and on which components do I need to do work? I think that will be the biggest challenge. From firms, large and small, like larger firms will probably use like the whole standard and get to the full depth of it with a large international audit, while a lot of smaller firms will only use parts of the standard, given that they have smaller group audits that probably also don't use component auditors. On LCE, I actually hope there won't be any challenges, because the purpose of this new standard was to simplify things. And like maybe to keep the short answer to this, like it's new, so it's harder to answer, but I hope there are not no challenges with applying this standard. The structure is of course different, but we're trying to make it more intuitive for practitioners. Thank you.
Thank you very much. So thanks again, IAASB, for the great presentations and also for answering all of our questions. I would also want to thank the audience, very engaged audience, over 250 connections throughout the whole seminar, and for very active participation with 15 questions that were duly answered by our panelists. I also want to thank both our CFRR team in Vienna and this wonderful team of interpreters that always deliver, even if sometimes the audio it's not ideal. So a big thanks for them also for a great work. With that, this is the end of the seminar. Thank you all for attending, and see you in next seminar. Thank you very much.